Good morning, everybody. Sorry we weren't able to see each other face to face. My name is, as Ken said, Bill Moore. I'm the Chief Risk Officer of Compeer. We're going to hear a lot about market disruption over the next 20 minutes. I did want to reiterate something that Kent said earlier as he kicked it off. Compeer is open for business. We're here to help our clients. That's really important for us to understand and for you to understand. And, you know, crisis is tough to live through for sure, but it also breeds opportunity. And we want to make sure that we're all on the same page from that aspect as well. So where are we? If you've seen any of our presentations or my presentations in particular over the last 2 years, you know, I've really noted that the markets were stretched and fragile. And when that happens, you know, self-fulfilling cycles can take hold. And the markets don't like uncertainty, and they react hard when things happen that they didn't expect. And what we're experiencing now is essentially the motherlode of uncertainties. And when those two things about uncertainty and expectations come together, we get what we're experiencing today. Today's market prices reflect kind of the collective market's expectations of whatever and could ever happen with this disease and disruption to economic activity, and that causes the lowest common denominator to essentially drive the markets. We've seen the stock market decline about 30% from its February peak. It's happened in a very rapid stage, probably the fastest decline by a calendar perspective that we've seen potentially ever. There's been a real significant rise in volatility. If you look at the VIX index, which tracks market volatility of options in the S&P, we're about equal to where we were in 2008. The credit market conditions are fragile, but they are functional, and that's fairly important to understand. And then on top of this, what probably would have been the biggest story in the world, a huge oil fight between Saudi Arabia and Russia, is at this point a footnote to the market news, but it's really added a third dimension to the mess we're experiencing. Talk about outdated, we've got big swings. We're probably likely to have 8 straight days of over 1,000-point swings in the Dow Jones. As I mentioned, the outdated, I've only got, 6 of them here today. You do note that I mentioned the swiftness at which it's moved. 2 of the last days, of the last 7 days, have been the biggest single-day market moves, market losses in the post-war period of the last, 40, 50 years. We're number 2 and number 3 on the 16th and the 12th, respectively. And it's not just the stock market that's moving around. If you look at the Treasury securities, they've moved down quite a bit as well and have been really volatile. The 30-year Treasury traversed kind of the single largest range from one spot, from min to max, that we've seen since 1987. This is in government securities. We dipped on the 10-year to something about 31 basis points on the 10-year. And then this is also last week, so it ends on Friday, but we're a little higher than this today. You did see that it was a quick shock down, and then as things moved on and the market became a little bit more liquid, the rates moved back up again. We're now a little over 1%, 1.15, I think, in the 10-year today. And that gets reflected in this yield curve chart. I guess that's an orange or burnt line there is where we started the year in terms of the yield curve, with the short maturities on the left-hand side of the screen and the long maturities, treasuries, on the right-hand side of the screen. And on the 9th of March, so a little over a week ago, that just straight dropped down. And since that point in time, we've actually had a little bit of a steepening of that curve. Long-term rates have moved back up. They've started to put in not a risk premium, but more of a liquidity premium into the market, as there's a lot of different transactions happening between banks, between governments, funding, securities, things to that effect. And it's worth noting that in a flight to safety market like we have today, you get an early run into treasuries, and that's because that's the safest security which you can put your money into. But that doesn't necessarily translate across the board to fixed income. As you move away from the government guaranteed or government obligations, you start to see risk premiums built in the market. So things like mortgage-backed securities moved fairly wide and became a little bit illiquid. Corporate securities moved much higher. High-yield corporate securities moved even higher than that. Farm credit in and of itself is not immune. While we price ourselves off of treasuries, we've seen our risk premium spread, or our spread above treasuries, has widened in the last couple of weeks. Continue to function. We continue to be able to borrow. We're just borrowing at a slightly higher rate above treasuries than we have historically. It's really caused the Fed to get involved. The Fed was not going to be behind the 8 ball in terms of world events. And they made that known on March 3rd when they cut rates 50 basis points. And a surprise move, inter-meeting, meaning between their 2 meetings. And then they did it again on Sunday, March 15th. They did it Sunday night. In total, the Fed has cut the Fed funds rate to 0 at this point. Those inter-meeting moves, they're not unprecedented. They do happen, but they are fairly rare. If you go back to when Alan Greenspan, the former Federal Reserve Chairman, started to tell the market what the Fed was doing, and that happened in the early 1990s, they've only had, other than these most recent ones, 8 times in which the Fed has cut rates in between meetings. And for the most part, those have happened during fairly monumentous times. This is a list of them in front of you here today. You can see things like the dot-com bubble bursting, a Russian sovereign default. The mortgage crisis was the time they cut it in 2007 and 2008. They cut it twice in between 2 meetings. And then you saw the Lehman Brothers bankruptcy also fit that list as well. And now we've done it twice for the coronavirus. You can see those are fairly monumentous events. So as we look at the Fed actions, monetary stimulus was kind of their first action. They were cutting rates on that mid-meeting, Feb's March 3rd concern. They cut rates. They also indicated a real willingness to go in and purchase financial assets. And then I stole this from someone else. I'm not even sure who I stole it from, but the next move is what I'm calling the kitchen sink. They threw the kitchen sink at it. By cutting rates the way they did on Sunday, they really sent a signal that they're shooting all their bullets, because not only did they cut rates, they increased access to the discount window at the Fed for banks, meaning they can go to the Federal Reserve and borrow money. They started putting money in the repo markets. That's the money that banks use to lend to each other on an overnight basis. And in the last 2 days, they've created 2 facilities to help facilitate liquidity. One, by providing loans to commercial dealers, and another to help work the commercial paper market. So the primary dealer credit facility and the commercial paper facilitation facility, which is what those acronyms stand for, were really targeted towards making sure there was liquidity in the market. Because that's really what disrupted 2008, was the fact that we hit a stretch where liquidity of the banks was really, really poor, and the Fed was not going to allow that to happen again. And they're not the only agency to do that. The Treasury Department has done the same thing. Steve Mnuchin, who's the Treasury Secretary, was out on, I think it was last Friday, went out and said he's assuring that banks have liquidity. He wants to make sure that if they need money, they will get it. Similar signals have been given to the Farm Credit Funding Corp. There will be liquidity in the market for those that need it in the fiscal institution. That's important. We're also seeing the fiscal stimulus on from both the White House, the House, and the Senate. We're probably seeing agreement on things like paid leave, food and health security. We saw yesterday a proposal for as much as $1.2 trillion in spending, which would possibly include $1,000 of direct payments to households. This is probably affecting the small businesses as much as anybody, and the Small Business Administration, SBA, has agreed to put out up to $2 million in economic injury disaster loans to help buffer the impact of the outbreak. There are some caveats to that borrowing as well. Businesses have to show that they can't get credit elsewhere, but still an important step. So net, I think the pandemic, given the unprecedented times, the sudden stop in economic activity, the self-quarantining, the event cancellations, the social distancing, all those things, they're going to have an impact on the economy. We are, in my opinion, clearly in a recession today. We're in the third of 3 months of the first quarter. We'll probably sink the first quarter GDP by about 2%. We'll probably see it down 2%, 1Q 2020 number. The early estimates suggest that the second quarter could be down 3%, but I've seen numbers that are even bigger than that. And then what happens in the second half really fully depends. Where does this virus take us in terms of how long things like shelter in place in New York City hang on and hang in there? The good news, as I mentioned earlier, it should look a lot different than the 2008 recession, mostly because the banking and the financial system is in fairly good shape. But if you take a look across the globe, the baseline of where we were from a GDP perspective, green is above potential, orange is below, and red's in recession. The U.S. was running about 1.8 to 2.0 in terms of GDP for 2020. So that's a little bit below potential. But now if we start factoring in a significant risk of a pandemic scenario, a large chunk of the world would be in recession, which is clearly not a good thing. But if you look at where some of the modeling suggests, we're seeing year GDP numbers that could range between 3 and 4% for the full year. If you're familiar with the banking system, they do a stress testing event every year that the Fed and the FDIC provides that makes banks stress their capital. They stress GDP to be down, 8, 9%, 10% at the low end. The current forecasting suggests we're more like a 3 to 4, so we should be well within that range. Why do they think that's where we'll end up? Well, if you look at the GDP of Hong Kong as an example, when SARS hit in the 2004, 3-4 timeframe, that GDP dropped a little more than 2%. And at this point, the coronavirus is being compared to SARS. So that's essentially what the baseline of what we're predicting is. Now, what does it mean for the ag economy? There's probably a few people on this call that could probably talk to that a little bit more strongly than I, but a couple of 10,000-foot pieces of information. We've done some analyses in the past, and we've run our own stress tests over the last few years. And ag is mostly uncorrelated from the general economy, and that meaning they don't necessarily move together. So a decline or a recession in general doesn't necessarily mean one way or another for the ag economy. The decline in interest rates should help maintain land values. That's a positive. And food, as well as toilet paper, appears to be the thing that's running off the shelves. So there is spending taking place in the food sector, which is a positive. Restaurants are down, obviously, but grocery stores and eat-in at home is up. There are risks, though. Clearly, labor availability would be one of them, particularly for an labor-intensive business in livestock, whether that be on the swine sector or the dairy sector or the packing plants. Labor and people's ability to go to work is an important factor of how this will all play out that we don't have an answer to today. Off-farm income, depending on how long the recession stretches itself out, could be a problem. There'll be people in the restaurant sector, in other services businesses that won't get paid for a couple of months. And so what does that mean? Transportation or logistics issues are a factor. Exposure to exports will be really important. How does this play out in the export market? I don't think we know the answer to that today, and that will affect some markets more than others. And then finally, obviously, the significant volatility in commodity prices, peak to trough, can be short-term issues that we need to manage through, if not turn into long-term issues based on what happens. The grain sector, well, the growing season could allow us to bridge on the Midwest side through to any recovery. If this is a short downturn and a short recession with a rebound back in the second half of the year, we could bridge what could become the real crisis part of this recession. Now, the one factor that we are keeping our eye on is what's the impact to ethanol, because ethanol will translate to what happens to corn. If gasoline consumption falls for an extended period of time, ethanol production could lose anywhere between 100 and 200 million bushels or more. And if you take a look at where the ethanol business is today, they're operating at a negative margin all in. That includes depreciation. We're in or around kind of the shutdown or continue to operate levels. Gasoline futures, the futures market, have dropped rapidly in the last couple of days. And gasoline futures have dropped from about a 1% premium to ethanol, which is about where it's been for the last few years, to today it's about a 30-cent discount. So if the thought is to maintain margins today, it's on a parity basis. If ethanol was to drop to where gasoline is today, you'd either have to see a change in basis or you'd have to see corn drop by as much as 80 to 90 cents a bushel in order for ethanol to maintain the same margin and continue production. If that doesn't happen, we'll probably see some go, no-go, or long-term spring shutdowns for maintenance that extend longer than expectations, which again would affect the demand. So that's the one place we're really keeping a significant focus on. So who are we watching throughout this to figure out what the length of this could be? Well, China is a great example. It all started in China. It started early in China. We'll see how that plays itself out. And right now, it points to what I'll call good news, for lack of a better term. The robust public health response in China has stemmed the epidemic there. In fact, you look at the chart on the right, that's daily incremental cases outside of the province that have been gaining, and they've dropped significantly, almost to near zero. This is the exact reason why we are doing self-isolating and holding webinars instead of in-person conferences, because we want to be able to stem this. And if you look at the trend of China, the blue bars, I think that's blue, you can start to see what the cases, where the peak cases took place. Now, cases and diagnoses aren't the same thing, and that's something we need to consider when we look how it plays out in the US and in Europe. Cases aren't known until the diagnosis takes place, so this is somewhat backward looking. When you get diagnosed on February 5th, the doctor says, well, when did you start experiencing symptoms? And they say January 25th, and that's marked as when the date of onset begins. So you can see that actually cases in China began to slow down as early as the end of January, even though the diagnoses really didn't peak until early February, and then they started to decline. The onset case is really the factor we want to look at today, because that's going to be applicable to us. So how long does this peak start to trend up and begin to trend down in the United States will affect when businesses can start to open, people can start meeting, people will begin to start going on airlines again. And while this chart is kind of old, this is at least a week or even more old, it shows where the world is on the life cycle. China is the front end and is already starting to experience recovery and is likely further to the right than this chart actually shows. And then every other country is a little further up the line. In fact, I think from what I've seen, South Korea may actually be on the downside of that accumulation stage. Italy's up near the peak. The United States is in the acceleration phase. So how long does this take to play itself out? Today, people are saying we should be through this by end of May, beginning of June. That could prove to be optimistic. We don't really know. But why is it important to economics? Well, if we look at China, you can start to see where the expectation plays out in their GDP. And it's probably likely to bottom out in the third quarter of 2020 and then begin to pick up in the fourth quarter and then back to normal by 2021. So if it plays out in the US the way it played out there, we could see a real mixed results of 2020 and then begin to pick up in 2021 from a GDP perspective. One of my favorite slides that I've shown probably to this group or at least others in the past is that cycle of emotions. And it's really what I base my risk-reward theses on. At times when everybody's really happy and everybody thinks everything's going well, that's your maximum point of financial risk. And when everybody's despondent or in panic or in depression, that's the maximum point of financial opportunity. 6 months ago when I showed this chart, I suggested we were somewhere in that green. We were somewhere between thrill and nobody was really at anxiety yet. I think we're pretty clearly right now somewhere between that pale to red perspective. So we're maybe not at the maximum point of financial opportunity, but we have to be approaching it. And nobody can ever really call the physical bottom. So it becomes the time to start figuring out when are you nearing that bottom and when is your reward beginning to outweigh your risk. So let's look at that in the financial markets. This chart shows in blue where we are today in terms of the Dow Jones stock market. We're down about 30% in late March here. The red line is a relative perspective of where we were in the financial crisis. We moved from a relative point of 100 to 57, and we're at 70 today and done it much quicker. I mentioned the banks run their stress tests, which show as much of GDP decline of 10%. They also impose a market decline. That would suggest 67 would be the downside of their market decline on that GDP decline. So we're in and around both those two numbers. And then you need to look at, well, where are we from a valuation perspective? You can look at things like price to earnings ratios. And if you look in the last 10 years in the S&P 500 and the forward-looking 12-month earnings, so what are people's expectations for earnings in the next 12 months? What's your PE ratio? Well, we've dropped from about 19 to about 14. Now, I'll caveat this a little bit because we'll probably see earnings estimates, which is the denominator here, go down somewhat. So if you refactor that, we're probably more like 16 times earnings, but still at a much more favorable spot than we were, say, 3 months ago or 2 years ago. And then the last slide from a statistics perspective that I'll show is a thing called the CAPE ratio, or what's called the Shiller PE. And what this does is it's a cyclically adjusted price earnings ratio. It's a valuation measure that looks at earnings over a 10-year period of time and compares it and uses it as a stock market valuation. It's not a great short-term indicator, but it gives a decent sense of what your possibilities of returns are going forward. The gold bar is where the CAPE PE Shiller ratio is today. It's about 23. We were at about 32 just a few months ago. The dots on here are what the returns on the stock market were for the 2 years following whatever date that PE ratio was measured. So this bar right here, I don't know if you can see my cursor or not. No, you cannot. The green bar is when the Shiller PE was above 30. You have many periods where the next 2 years of returns were negative in the S&P 500. But as you move to the gold bar where we are today, the 2-year returns going forward are basically non-existent and start to approach, a decent expected return for equities. This is basically telling you that the opportunity is beginning to emerge once again. So as I conclude the items together, the markets were probably due for a shock, both in valuation and in economics. The coronavirus was just the catalyst for it. We always talked about the thing that causes a recession is the unexpected event that nobody was planning for, and this is clearly one of them. If contained appropriately, which is the actions that we're taking today, it can be a modest reset of valuations and hopefully a short economic impact. The risks include that the disease lingers or gets worse for sure, and that's something nobody can predict, and it has a longer-term impact on the economy. The ag market is not connected to the general economy, but there are tangential relationships that we need to manage, particularly from the commodities price and the exports price. Market's risk-reward trade-off has shifted in the favor of reward. Whereas I had been saying as much as 4 to 6 months ago, it was certainly in the favor of risk. I think it's now in the favor of reward. And crisis breeds opportunity in business, and this is no different. So at this point, turning it over to Brent, but I will stick around if we do have questions.